If you're still not a profitable trader in 2024, then it's probably because you don't have the correct understanding of market structure. If you actually understood true market structure, you would be on the right side of the market most of the time. And so then it's just about entries and psychology. In this video, I'm going to be giving you the 5 golden keys to help you master market structure in 2024. And as a bonus, I'll be adding how to create a trading strategy from these concepts. Now, honestly, this may be the most important video I've ever created. Now, let's cover the golden keys. Golden key number 1 is going to be understanding your foundation, basic market structure. Golden key number 2 is going to be practical market structure. Golden key number 3 is our golden rule. Golden key number 4 is premium and discount, and also OTE. And golden key number 5 is going to be fractal market structure, the most valuable asset. And of course, as a bonus feature, a full in-depth strategy that you can apply off the back of this video. Without further ado, let's go ahead and get into the video. But before we do that, to show the support for all of the effort that I put into giving you free education that is better than most mentors' paid education, subscribe, like the video, and of course, if you're a true supporter, comment something down below. Let's get into the video. Now, let's begin with golden key number 1. This is simple, but it sets the perfect foundation for you to build off of. So we'll start basic and we'll get more advanced as we go. So on the left here, we essentially have your expectation of how you would expect, or how these textbooks or simple education would show you market structure. Essentially, you will always have a low and a high. And essentially, you will have to determine whether price is bullish, i.e. going up, or bearish, i.e. going down, based on the trend. So ultimately, you essentially have a low, a high, and this is called your swing points. So we're going to map out swing point low, swing point high. Everything inside of this low and this high represents a range. This is very, very important because a lot of the time people will get lost to understanding what is my swing point and what isn't my swing point. So everything inside of this gray area represents internal range until, of course, we break out of that box. Now, in this case, we break out of this box to the upside, which is what? Bullish. So we have a bullish break of structure. Now, that right there sets our foundation for our market structure. We are bullish. So price puts in a high, a lower high, right? This low down here is lower than the previous high. It's a lower high. And then we go higher high. This high is higher than the previous high. That's very, very simple, basic market structure 101. Price is now bullish. So what are we expecting? We're expecting a pullback, right? To create a gain, a higher low, and then a higher high, giving us again a break of structure, continuing the trend until once again we have a pullback, and then we continue and go higher high, again giving us a break of structure. Now that is essentially bullish market structure. And if we were to flip that, we would ultimately just get the exact same thing, but being bearish. So it would just be lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, and lower lows. Just bearish, right? So this is bullish, but this is the expectation. You see, the markets don't quite work with these simple, basic understandings of market structure. Essentially, this is the reality of market structure. Price will oftentimes look like this. And the thing is when you've just come from an educator or some essential pieces of content that have shown you market structure to be like this very basic thing, and then you come into the real markets and it looks like this, you are completely confused, and understandably so. So what I will do for you is I will lay out how to actually use this applying to the reality of price action. So we're going to do the exact same thing again. We're going to find our low and we're going to find our high, just as we did previously. Now what we're going to do is this is our swing high, and this is our swing low. And what we're going to do is we're going to do the exact same thing as we did before. What we're going to do is we're going to pull from the high to the low, like so, and anything inside of this box until we break out either up if we're bullish or down if we're bearish is internal. You see, the issue that a lot of people have is they don't understand what low should be ultimately market structure. So a lot of the time you'll see people mapping out, okay, this is the low and this is the high, and then we break here, and so now we must be bearish. And so if you ever get caught in that because you don't understand your swing ranges, you may look at this low, look at this high, and then go, okay, lower low, right? So we must be bearish. And so from here, you're trying to short, when in reality, you're just getting caught on the wrong side of the market. And this is what happens to 90% of traders who aren't successful. They just continuously get caught on the wrong side of the market because they don't have rules in place to show them what side of the market they should be trading. So essentially, we have this box, and anything inside of this box is internal structure. We have two types of structures. We have our external, that's what makes up our actual market structure. And we have our internal. This is ultimately just the phases in between price that essentially are created to, ultimately, not necessarily they're created to confuse you, but they do confuse you. So what we want to do is we just want to be aware of all of these internal ranges, but until we break to one side of this range, i.e. in this bullish scenario. So let's say we were previously bullish, right? So we have a high, we have a low, we had a break of structure to the upside. So we already know we're bullish. So we were already expecting price to go higher. And so when price does go higher, right, we get a break of structure to the upside like this. And so now we have a new swing high. A lot of you people are sat there thinking, well, what is my structural range? A lot of people will make, again, another huge mistake of doing this. They see that price gets broken in here, and then they look at this low here and this high, and they say, we're bullish, and now this is my low and this is my high. And again, a huge problem that comes from this is when this low gets broken, what are you guys doing? A lot of you guys are thinking that price has just gone change of character, right? You think now it's bearish, and now you get in the wrong side of the market and you start trying to short, when in reality, the market just pings against you because you're on the wrong side of the market. So how do we actually have a rule-based mechanism in place so that we know what is our swing low? Well, that's where the box comes in again. You see, we're going to look at anything inside of this low as our internal until we break out of the range. And then our job, our actionable step, is to go and find the lowest point that price pulled back inside of that range. And so we look at this low, and then we have a new low, and then we have a new low, and then is this lower? Is this low lower than this low? Let's take a look. Okay, I'm just going to put it down. Let's say it is. So we know that that low is lower. Okay, so now that right there is our lowest point. And then we break out. And so what do we have? We have the lowest point that came inside the range that caused the break of structure. And then we understand that we have our high. How do we know that this is our swing high? Because it starts reversing. And so the swing points of market structure always create a pullback or a continuation. They are the external swing points. How can you identify swing points? If we look at the very basic of models, we just understand that it's the point where market begins to shift in the opposite direction, right? We come up, we top out, we begin pushing back down. We bottom out, we push back up. We top out, push down, bottom out, push up, right? It's the external swing points. It's very clearly seen in simple scenarios. But in these scenarios, it's a little bit more tricky because some of you may look at this and think that's a swing point. Or you may look at this and think, oh, okay, that's a swing point, and then we're bearish, and then we're shorting. Because you don't have these rules in place, right? And I've gone through years of getting these rules to where they are today. So with that being said, this is now our swing low. So we're going to map this out right here as our swing low. And we're going to map the high right here because this is the area that caused the pullback. Again, if we're just looking at the basic model, it's not that much difference, right? High, low, higher, higher, low, higher, high, and then you guessed it, yeah, higher, low. Why? Because again, if we just map out the box again from the new range, the high to the low, and we draw it across, right? Essentially, we have the break of structure back to the upside, which is, of course, as expected. Break of structure, continuation. Now, where is the swing point? Well, of course, now you already understand our rule-based mechanism. You will know that this is the lowest point that price comes inside of this range before going and putting in a new higher high. So yes, of course, that is our new swing low. And it's just rinse and repeat, rinse and repeat, rinse and repeat until at some point you'll get something that looks like this. We're expecting price to essentially have some sort of reaction, but it doesn't. Price no longer respects our once bullish market structure. And now this is something that I really want to make you guys sure on, is the fact that you will never be right 100% of the time. You have to come to accept that fact as a trader. You will never be right 100% of the time. And that's okay, because your job as a trader isn't to be right 100% of the time. It's to make more when you're right than you lose when you're wrong, right? That's literally the aim of the game. You're not here to be perfect, you're here to make money. And so this right here is called a change of character. And so a change of character, if you just imagine, you always at 2 points have two characters involved in the market. You have a bear, which is bearish, and you have a bull, which is bullish. Those are our two characters. And so it's a very simple understanding of who is in control, which character. Well, when prices go in higher highs, higher lows, higher highs, higher lows, higher highs, the bull is in control, right? We are literally bullish. But the moment that we shift from higher high to lower low, we go bearish. And that right there is our change of character. The change of character is essentially the difference between the break of structure and the change of character isn't much in nature. It's really about what it means. A break of structure is a continuation of trend, but a change of character is a shift of trend from one side to the other. And so this is our change of character. And so again, a lot of people will be looking at this and thinking, well, where is my swing high? And it's no different. Now you know that you have your price range, right? Price begins to reverse. Now you know you have, okay, well, this is my new swing low because price is obviously at a swing here. It's begin pulling back up. So we can map this out as our M15 swing low. And this right here is the current high, right? This is the highest point of the range in which price broken. And so literally, if we just pull out our current range from low to high, we understand that we have a swing low, and just above here, we have our M15 swing high. And now, what do we ultimately expect? Well, if price has just shifted bearish after a long rally of being bullish, price is probably going to have some sort of continuation. So price is going to come up, something like this, and then continue moving back down. And what do? We just do this exact same thing again. If price shifts from bullish to bearish, right? Lower low, higher high, lower low. What do? If we just look at the deepest point of the range, right? From the low to the high, where is it? It's here. Not here, right? It's here. And that becomes our new swing high. And yes, you guessed it. You just keep playing this rule forever, right? Ultimately. That is literally how it looks in reality. And that's the rule-based mechanism of how to determine what is your swing low and what is your swing high. However, now we're going to actually understand and go deeper, one step further with our exact rule to understand a pullback. Without this, you are, again, completely left in the dark of what is structure and what isn't. Now, golden key number 2 is our golden rule. This is probably one of the most important rules we have when it comes to market structure, because this answers the question, how do we identify a swing point? And so many of you have the problem with this. That's actually why I've put it in this video. You ask me all the time, how do we know if something is a pullback or not? Well, let me answer that for you. Our rule is simple. 3 candles that close below each other in the opposing direction. Now that's the code, right? How does that look? Well, if we understand that we take our low down here, and then we have to answer what is the swing high. And so we know that we said it's the external before the pullback, but that's it. What determines the pullback? So a lot of you may be looking at this and thinking, okay, well, this is our swing high. And then we have the pullback, low, break of structure. So now we're bullish. Oh, but when we break this low down here, Now we're bearish and you guys are getting ready to sell and price takes you out. Why? That's because we have a very simple rule. 3 candle pullback. All of those candles have to break and close below each other. They do not have to be in a row, but they have to be within the price leg. So for this, we can just simply go, well, this is our low, right? And let's expect that we are already bullish. So we'll do something like this, right? We're already bullish, so we've had a break of structure. So we know that this is our swing low, but what is our swing high? Well, if we take the rule that we've applied, we can look at this and we can go, okay, well, this is the high. So we have 1 bearish candle, 2 bearish candles that breaks, but we don't get a 3rd bearish candle. Therefore, this is not the high. This is inside of the price leg. So we keep going again. Well, maybe this is the high. Well, let's take a look. 1 bearish candle, we break and close below. 2 bearish candles, we break and close below. That's 1, 2, 3 bearish candles in the price leg that all break and close below each other. Therefore, that is our pullback. Therefore, we can conclude that this right here is our swing high. And so we go from high to low to higher high, but then this isn't the pullback. So this becomes our new higher high. And then we go higher low and then higher high again. If we get 1, 2, 3. Now, why is this so important? Because a lot of you guys would have marked this as your high and then this as your low, as I've already explained. So a lot of you guys would have been looking to long from here, and then when it doesn't work and it fails, you're looking to short. And in both sides, ultimately, well, not this one, but in this second scenario where you're trying to short, you're on the wrong side of the market. And that is most traders' problems. They're on the wrong side of the market because they don't have these rules in place. They haven't thought these rules through. And so that is the key point to identify a swing point. It's the highest point inside the price leg that has at least a 3 candle pullback. Now, let's go on to key number 3. How do we apply this to the market? Well, let's go and take a look at the actual charts. So here we are, and I'm just going to essentially start from this. So here we are, GU 15-minute time frame, our predominant time frame when it comes to mapping out our market structure and how essentially it is that we ultimately trade. So we're going to just start with this low and this high. So we're going to pick this low and this high as our swing points. And then essentially what happens? Well, this low creates this high and it has at least 1, 2, 3 bullish candles, right, in opposition. So awesome. So then price has a break of structure to the downside. And so what we need to do is we need to determine, well, what was the swing? So we need to go from low to high. And we need to make sure that this is... So we go from low to high, right? And then we break structure, and then this is the low. And so we go 1 bullish candle, 2 bullish candles, 3 bullish candles. And so there's at least 3 bullish candles that break each other and close above each other inside this price leg. So now we have to assume, well, this is our swing high, right? Because it had 1, 2, at least 3 candles to have the continuation. So this was our swing high. Now, this is where a lot of you traders may get yourself in trouble. You may think this was the swing high, or this was the swing high, or you don't know which one was the swing high. And that was the whole point of just explaining to you everything that we've just gone through. So now you should be able to identify your swing highs, but let's keep going. So we go lower low, right? We have our pullback. We're still inside of this range. So we understand that anything from this low to this high, which is our current trading range, anything inside of here is internal until we break either down or high. And so what do? We come high, we pull back, we come high, and then we break. And so there we have our new swing high, because we're just identifying the highest point that price pulled back inside this box. That's the most simple way that I can put it. The highest point that price pulls back inside of this box, because that's our trading range, which is this right here. So that now becomes our swing high, because this is the high that produced this swing low down here, right? So this is our high. And so what we need to see is, or what we would be expecting to see most of the time, is a pullback into somewhere inside of this price leg, right? An area of supply or demand, and then continuation lower. But in this scenario, we actually shift to bullish because we have a change of character. We have the previous higher high get taken out. So essentially the previous higher low, get taken out. So essentially we have lower low, higher high. right? Instead of high or low. So with that is a change of character. We go from bearish to bullish. And essentially we can look again. Well, how do we know what's our swing? We come in here, this is the high, this is the first bearish candle. So we have one bearish candle that pushes down. Second bearish candle closes below it. Third bearish candle, very slightly, but if you can see that, it closes below it. So that's 3 bearish candles. So we know then that that is our swing high. And so if we, again, do the rule, we just go from the low to the high until we break out of that, which we do right here. We're going to now identify what is the lowest point in that pullback. Well, obviously it is this low right here. This low then produces this high. And that right there is our higher high. And then again, what do we have? We have one bearish candle. This second bearish candle closes with a wick, doesn't count. Second bearish candle closes with the body. Third candle closes with the body. That's a 3 candle pullback. However, in this scenario, we've actually broken and closed below the previous low, which is again another change of character. So yes, in this scenario, you would now be looking for shorts. And unfortunately, the change of character doesn't hold, and then it shifts once again. A change of character once again. And that is a perfect example, and that's why I included it here, is you will not be correct 100% of the time. But that doesn't matter. That's not the most important thing, right? The most important thing is, can you read it? You'll be right enough times. Can you make enough money on the right trades? Then you lose on the wrong trades. That's simple trading. And so from here, essentially we have, once again, a change of character. So we're bearish, but then we get a change of character again, taking out the swing high. And so essentially we are once again bullish. Now, from here, we'll just keep reading the price action. So we have a change of character, right? And so this we know is our current swing low. We have to find our swing high. We need 3 candles in the opposing direction. And so if we look at this high here, we have 1 candle, 2 candles. That's not a pullback. That right there is not structure. So we go again. 1 candle, 2 candle. This has at least 3 candles in the opposing direction. This becomes our swing high. And notice that you can go from a relatively small trading range to a large trading range. And that is totally fine. That's what throws a lot of people off sometimes. They think because the trading range has gone from so big to so small that it doesn't matter. So this is our highest point. And that right there, we have our swing low down here to our swing high. And so anything inside of this is internal. All we're looking for is long positions, right? Price is bullish. We're just looking for long positions. Price pulls back, and then eventually, as expected, price takes out the highs, right? Break of structure. Price just continues in the trend. And so what we have here, this little piece in here, is essentially a false change of character. It's where price changes, but it doesn't actually mean it. And so what you have to understand is we're applying mechanical rules to a market that doesn't necessarily say that, you know, your rules of 3 candles is correct. And so there will be some times where your rule doesn't work and you get on the wrong side of the market. And that's totally fine. Totally fine. It's just about understanding that most times it does work, as we can see. It works once, it works twice, it works 3 times. It doesn't work, and then it works, and then again, break of structure, and then again, break of structure. And so as long as it continuously works and you can find entries within that, well, ultimately, that is the most important thing. So let's continue moving. Essentially, we have high. We have the lowest point inside of this box until we break out. Well, that right there is our trading range. All of this stuff is internal. And then we go break of structure. And remember, guys, when we get to the bonus, I'm going to be showing you how to take this and turn it into a trading strategy. So once again, we break out, right? Break of structure. And we go up to this high. Now we have to understand, does this high have a 3 candle pullback? If it doesn't, it's not a high. So let's take a look. Price goes to the high. We have 1 bearish candle, 2 bearish candles, and then at least 3 inside the price leg that break and close below each other. Therefore, this is a high and this can be the low. And so when we break the high, we know that we have the low. So what do? We simply just go from low, high, drag it across, we break structure. Okay, awesome. Now we've had another break of structure. And then we go, does this high have 3 candles? 1, 2, 3. Yes, it does. Okay, awesome. So then this can be our high. The furthest point before price breaks to the upside is this right here. Okay, now, can this right here be our high? can this be a high? Well, no, it can't, because it has one bearish candle, two bearish candles, no third bearish candle. Therefore, this cannot be our high. And then from there, can this be our high? Well, one bearish candle, two bearish candles, three bearish candles. Yes, it can. Pull back, push up. And so that right there is once again when price shifts, right? So, and again, don't be alarmed because we've gone from such a large trading range to such a short trading range. Because again, regardless of the size, the rule does work enough times for you to be on the right side of the market most of the time. And then you just have to perfect your entries and your psychology. How? Because look, this is where we get our change of character. So now we expect that price is going to continue trading lower. And if we just bar replay this, we're expecting for price to continue trading lower. And this is where we'll get into the strategy again at the end, because there's many profitable trades using just these concepts inside of everything that I've just shown you. What happens? Well, we have a change of character. So now we're expecting price to go from bullish to bearish. And so we want to see some sort of pullback, right, before trading lower. And so if we know that information before it's happened, well, how do you think we're going to be able to build an edge? Well, if you just look what happens, price pulls back and then trades lower. But now you have to find a 3-candle pullback before you even begin to think about having a different market structure. And so let's play price out. Okay, so we get a low, we get one bullish candle, two bullish candles. Okay, we get a third bullish candle, but it doesn't break above the high. Therefore, this is not a pullback. So we're still on for our swing high up in here. Let's continue playing price. Price has one bullish candle, two bullish candles. Again, not a pullback. One bullish candle, two bullish candles, three bullish candles. Okay, so we know that right now, once we get those 3 candles, we know that this becomes our swing low. Because if we break below this, we have a new swing high. So now we understand that this is our swing high and that this right in here is our swing low. And so price, again, oftentimes will come back at least 50%, which we'll get into in the next key. But sometimes it doesn't have to. Sometimes it will just continue from below, either or. So play price. Price has some movement, and then you can see, look, this is again one of the examples where the rule works so well, because we have our 3, we know this is our swing low, and look, this is actually the swing low if we look at it. And so trust me, I've methodically tested this inside and out. Okay, so now we get a break of structure. So once we get this break of structure, how do we determine our next swing high? We go from low to high. And we go, okay, well, what is the deepest area that price pulls back before we break? Well, it's this high right up in here, is it not? And then we have our break of structure. And that's just literally how you time and time again just read the market structure. And so break structure. And how many times have we been correct? If we apply our rule to this market throughout all this price action, how many times have we been correct and how many times have we been wrong? Well, this is not us, it's our rule. How many times? Okay, so 1, we're expecting lower lows, we get it. Okay, we're correct. We're expecting lower lows, we don't get it. Okay, we're incorrect. So we're right once, wrong once. Okay, price goes up, we're expecting higher highs, we get it. So we're right twice, wrong once, but then we're expecting higher highs again and we don't get it. So we're right twice and wrong twice. And again, even in that simple scenario, even if you just have a 1 to 2 risk reward strategy with a 50% strike rate, you're extremely profitable. But it gets better. Because from there, we're expecting lower low, we don't get it, we get a higher high, okay, unfortunate. So now we're wrong 3 times and right twice. And again, I wanted to give you realistic price action. So once we get the change of character, we're expecting higher prices. Do we get it? Indeed we do. And again, there's an important thing in here, which I'll get into at the end. So we expect it, we get it, great, 3 and 3. Pullback, expected higher prices, we get it, 4. Expected higher prices, we get it, 5. Expect higher prices, we get it, 6. Expect higher prices, we don't get it, we get bearish. Expect lower prices, we get it, great. Price comes up, we expect lower prices, and we get it. And so we're very clearly right on the market structure more times than we're wrong. And so what are we expecting now? We're expecting for price to come back, right? Something along the lines of this before trading lower. And so if we know that information before it happens, right? That's our framework, that's our bias, that's our guesswork. That's what the rules tell us. We're not subjectively guessing that that's what's going to happen. Our rules are telling us that it's going to do this. We just need to form, obviously, entry models and things inside of that. And so what happens? Well, price goes lower low. So this is our swing high. And already before anything happens, we're expecting something along the lines of this. This down here is our swing low. So before anything's happened, we're expecting something like this. And then how does price play out? Price just begins trading how it would normally trade. And what happens? Price essentially pushes down, has a pullback, and then keep playing price, keep playing price. Price takes out the lows, right? Literally as expected. And so we just come out of here and we go, okay, lower low. Where's the highest point that price pulled back inside of this price leg? If we go from low to the high and draw it across, once price has the break of structure to the downside, where is the highest point? Well, it's here, no? Yeah, okay, great. So that then becomes our swing high and price break structure. And so you can see time and time again, we're correct. So let's move on to the next key. Okay, now we're into key number 4, premium and discount plus OTE. So what is premium and discount? Premium and discount is essentially just a concept of supply and demand, right? If you take a price leg, which we have here, so we are bearish, right? We've had a break of structure to the downside. We have a high, we have a low. If you just draw the fib tool from the high to the low with the correct settings, I'll show you in a moment, you want to have at least the 50%, right? So this is the 0.5. This measures the 50% region of the level. Now, just think psychologically. If you want to buy something, you want to buy it at a discount. And if you want to sell something, you want to sell it at a discount. So think buyers get involved in the lower portion of a bullish leg, right? So I'll do the exact same example on here, but with a bullish level. So we have a sell scenario and a buy scenario. Now think of premium and discount as premium being the high of the leg and discount being the low of the leg. And so if price is bearish and you want to get involved in sells, as a consumer in any market, you want to be selling your product, which is what this is. GU is a product at a premium price. And if you're a buyer of something, and so in this example, if we are a buyer of something, we want to be buying at a discount. And so if you think of that at the psychology of the market, and all market participants have the exact same wire in us, they want to buy something in a discount and sell something in a premium. Think of the market when it's in the high of this leg and you draw the fib, you're going to have sellers step in and sell it because there is a demand to sell it because it's at a premium price. And then once it steps into discount, especially if you're bullish, expect a huge influx of buys because now you're buying a bullish market at a discount, right? The exact same principle stands true with bearish. As price lows and gets to the lows, you'll have people start buying it because they're looking at it perhaps as a discount. When it gets into the premium levels, those same people that brought it at a discount or other people are looking to sell it now at a premium. And that's just the way of the market. And so premium and discount is essentially just separated with a 50%. The top half is the premium, the bottom half is the discount. So any price leg, you want to map out the high and the low using the fib. Now I'll give you the settings. So with your fib will probably look something like completely random. It's going to look like, so I have all of these buttons selected. Unselect everything other than 0, 1, 0.5, which is your equilibrium. And then for now, just do 0, 1, and 0.5. That's going to give you the high, the low, and the middle. That's what's going to allow you to settle your premium and discount. Anything that's above 0.5 is a premium, and anything below 0.5 is a discount. And so if you're in a bearish market, it's ideal for you to be selling above the 0.5. And so if you're looking at this, you don't want to be selling anywhere under this level. You don't want to be selling at a discount. Doesn't make sense. You want to wait for price to come into a premium and then sell. The same is true for the bullish example. You want to be waiting for price to get below that 0.5 into that discount and then start buying once it's at a discount. And so this is how we use it. And then you're going to add another 2 entries in there. You're going to add the 0.618 and the 0.786. This is called the optimal trade entry. Essentially, this is a wide known phenomenon that for some reason, the 618 and the 786 price oftentimes reacts and bounces from those levels. Why that is, I have no idea. But why is it isn't as important as the fact that it does. And so it's just an additional confluence if you're inside of those areas. If you're inside of here and you get some sort of price shift like this, that's an extra confluence to add on to your already confluence of being in a premium to short the market. And then, of course, the exact same is true in here. Once you get into that area of this golden region and then you get some sort of shift, great opportunity to be looking at longing something. And so that is essentially the premium and discount and the optimal trade entry in theory. Now let's go and walk through the price action we just recorded and see how often does this thing work. And again, it's important to note that it won't work every time, of course. So if we come into here right now, we're just going to pull this from every high and every low. So we'll get rid of these boxes first. So let's start with our first price range. Essentially, we are bearish and we have a low and the high. So what we're going to do is we're going to map out the low. We're going to map out the high, to this low right here, because that's the low of the range. As you can see in here, there is 1, 0, and 0.5. Now, in this scenario, you will see that price doesn't completely come to 0.5, but comes very close. However, it doesn't come there, okay? No problem. The next scenario, of course, you can see the price ultimately changes character anyway, so it's not actually that important because price breaks it anyway. So we'll go on to the next one. Essentially, once price breaks structure, now you have a new low to a new high. Price comes obviously all the way in because it changes character anyway. And so we'll go to the next one once again. But from here, what you'll see is we have our swing low to our swing high. Much a larger range, which is honestly better because there's a higher risk to reward available. So we just map out the high to the low. It should have been low to high. So what I'll do is I'll click on here and I'll just go reverse. Now this is the high to the low. And what you can see is you aren't interested in anything above the 0.5 usually. Price comes to the 0.5. When it gets into this 0.5, you can then begin to look for longs. Now, of course, you need the confirmation with that, which I'm going to show you at the end of this video. But you also see that it comes just creeping off that 618 level. And so then we'll keep it moving. Price comes into our discount, has a reaction. We get into a trade here and we take it to the previous high. But then from there, what do you see is, well, we have a huge range now because now we have this high, right, to this low down here. And as you can see, price pulls back, breaks structure very quickly, and we don't get a pullback at all. So essentially no trade in there, which is fine. We're not trying to trade every single price leg, by the way. That's a very important thing to denote. We don't need to trade every single price leg. We only need a couple of wins a month to be a very successful trader and take a lot home, right? So again, this is now our low. This is now our high. So we'll go from low to high. And again, just correcting it back to its normal level. You'll see that price pulls back and it doesn't pull back to the 50%. No problem. Then we move on to the next level, right? We have our high to our low. And then you'll see price perfectly pulls back inside that 618 and 786. And then you'll see price pushes up, but then price changes character. So the moment that price changes character, you're looking at getting involved in the market anyway. And so this is what it's going to look like in the present moment, right? You're going to have something along the lines of this. Because price is now bearish, you're already looking at getting into shorts. This doesn't have to be a swing low. You're just looking at, okay, if price is going to pull back, where can I get involved? And so once that happens, it's going to be the same thing. We're going to literally pull our high to our low, like so. And then again, let's get a little bit into the strategy here, but now we want to look for a point of interest, anything 0.5 or above. And so we have a very nice fair value gap right here, right? imbalance, and then just above that fair value gap, of course, is a nice supply zone. And so that's where we're looking at trading from, because this is our low, this is our high. We're looking at selling at a premium level, right? Price comes into our premium level and then begins to what? Sell off. And again, you can do the same thing. Price doesn't have to have the swing low to swing high. You can have the premium discount inside of a price leg also. Like if we look at this, for example, right? Let's say we have a swing high, price pulls back, goes swing high again. Well, let's say price comes down like this, has some realignment, right? And now you have had a shift, right? We were bullish, internal then shifts bullish as well. Well, maybe you want to pull your premium discount internally, inside the price range, to get an entry inside of here to go long. So the Fibonacci premium discount doesn't have to be just swing levels. It can be internal as well. So we just used it for this. And then price puts in this high and then this low, right? Low, high. And so if you wanted to get back involved in the market, you would need to be looking at selling above this 0.5. And lo and behold, price just sells off. We don't actually get that pullback. No problem. Continue playing price. And if we just literally continue playing price, again, you'll be able to see that we could be looking at, again, from the low to the high. If you want to be looking at getting back involved in the shorts, you need to be shorting above this 0.5. And so we'd be looking at probably somewhere in the region of this. But price doesn't. Price has other plans. Again, literally not a problem. And so still haven't had our pullback. And so continue playing price, continue playing price. Now, when price has the 3 candle pullback, now we have our swing low and our swing high. Now we can apply the fib from a full scale, right? Because we've had a break of structure. Now we know we're coming for a pullback. So we can just go high to low. And ultimately we're looking for price to come anywhere above this 0.5 so we can begin shorting. And immediately what you see is we have a order block in here, right? You can essentially cover the entire high of the range, but we have an area of supply that is perfectly at the 0.5. You also have this area of supply, right? This supply range here, which is perfectly the 618 and 786. So you just have these as points of interest of when price gets into these regions, you can look at going short. And so continue playing price, continue playing price. Price comes into our premium. At that moment, you can look at going short. Whatever entry model or whatnot that you use, price has fulfilled its objective. We've come into the premium of the price leg. And again, there are many times where price can come into that premium, give you a reaction, and just continue trading higher. That's also perfectly okay. Our goal is not to be correct every single time. Our goal is literally just to make money. So keep playing price. Price comes into our premium, then has a break of structure. And so now we have a new range, right? We need to go from high to low. And again, we want to be looking at shorting from points of interest above this 0.5. And so what do we have? We have this inside bar as an area of supply. We also have the origin fair value gap, right? And then the use the entire range as an area of supply, right? So again, 2 points of interest, looking at entry models. Price comes above the 0.5. Maybe you looked at getting involved in shorts in here. Price gives the reaction, fails to take out the low, which means, again, if a high fails to take out a low, that high then becomes liquidity, another golden key for you. That liquidity gets taken, we come into and wick the 786, have some reaction again, wick it again, and then we come in above those levels and come right up to the origin, which is above the 786, still inside of a premium level. Then we begin to have our reaction to the downside. Price trades back down, doesn't take out the lows yet, and then takes out the lows, right? And it's just the same thing again, rinse and repeat, rinse and repeat. It doesn't play out every single time, but a lot of the times you'll see how price comes perfectly back into the premium or into the 786, 618, like it did down here, like it did up in here, like it did up in here. And then it's about getting involved in those trades. And so that's key number 4. And now we're going to walk over to our final golden key before we get into our bonus key, which is how to get involved in trades. So without further ado, let's get into key number 5. Now, key number 5, fractal market structure. Essentially, all price action is viewed individually on different time frames. You can view price action on the 4 hour, on the 1 hour, on the 15 minute, or the 1 minute, right? And they're going to look different. But all it is the exact same price action viewed in different time frames. And so this is very important because you could look on the 15-minute time frame and price looks bearish, and go to the 1 minute time frame and price looks bullish. And maybe actually price is bearish, but it's just coming for a pullback. And so that's what we're going to learn in this module here. So the black lines, that is the M15. And so you can very clearly see that the M15 is bearish, right? We just have a break of structure to the downside. So the M15 is bearish. We're expecting price to continue moving down. And now don't let this confuse you. If we just pull this across here, it's very simple. Price is bearish, right? High, low, lower high, lower low, lower high, expecting lower lows. And now all this is right here, again, don't let these two images confuse you. This just looks the exact same, right? It's the M15 if we looked at it as swings, right? This is how we read the M15. And so if we pull this back here, how it previously was, and we just map out the swings, well, the external swings would be no different than the internal for the M15. So all it is viewing it differently. Now, when you come on, the red is the 1 minute time frame. So you can see that the black, the M15 is bearish and it stays bearish. But for some reason, the M1 goes lower low, lower high, lower low, lower high, lower low, higher high. So we have a change of character. So the M15 is bearish, and at some point the M1 is bearish, but the M1 shifts bullish. What does that mean? That is time for a pullback. And so essentially, if you look at things, if the M15 is going like this, right, it goes to put in a lower low. As it's putting in that lower low, you're going to see the 1 minute time frame bearish. But then when it starts to come for a pullback, you'll look on the 1 minute time frame and it will just be putting in higher highs, higher lows like this. This is how the M15 is built. The M1 is what builds the M15. And then once you get the M1 shift, right, back to bearish, that's the time where we know the M15 is now going to put in a lower price. And so all it is we're reading the M15 price action on the 1 minute zoomed in real time. That's it. We get a head start on the game. And so what does that look like? Well, let's say, for example, the 15 minute is bearish. We've already concluded that. The 1 minute you can see is putting in these lower lows, and then it goes and puts in a higher high. At that point, what happens? The M15 bottoms out and begins reversing. The M1 continues bullish, higher high, higher high, and then it shifts bearish, right? Now, this is the key moment here. When this 1 minute time frame shifts from bullish to bearish, that's our key. That's the sign that the M15 is about to go and put in a new lower low. So we're about to take this low out. So that's our edge, right? We understand that before it gets there, with this signature, right, with this simple move, price is about to head there. So that is essentially when we come into the bonus in a moment, that's essentially our strategy. And I'll show you in a moment how we're going to trade that. So price goes higher high, lower low. Now that shift has happened on the 1 minute time frame, the M15 is about to start printing bearish again. And we're going for this low down here. So we go lower low, lower high, lower low, lower high, lower low, lower high, lower low, higher high, break of structure, or change of character, sorry. So the moment that we have this change of character in here on the 1 minute time frame, that's our sign of what? The M15 is coming for a pullback, right? It's going to stay below this, just like we've practiced in all of the most recent modules we've done. Don't let this confuse you. It's just as simple. This is the swing high. This is the swing low, because now it started pulling back. And what happens? As price gets up here, what happens on the 1 minute time frame? Let's take a look. Higher high, higher low, higher high, lower low. The moment that this lower low takes place, we now know that the M15 is about to continue taking out this low down here. But we know that before it's happened. And that's the point of an edge. We know something before it's happened. So how do we get involved in it? Well, when this change of character happens, we can simply, just as we did before, go from high to low with our M1, look for our golden region, right? This OTE 618, cover the high and take out the M15 low where price is heading. Like that. And so that right there also takes us into our golden, our bonus, which is how to build a trading strategy based off of everything that we've just run through. Let me take you to the charts and show you exactly how we do that. Okay, so here we are on the 15-minute time frame. Bonus, building a trading strategy with all the concepts that we've just gone over. So if we look at the M15 right now, what do we see? We see bullish price action denoted like this, right? For example, let's say we have a low, we have a higher high, 3 candle pullback, right? Higher low, higher high, and then we're expecting a higher high, but we get a change of character. So price goes lower low. So we go from break of structure, bullish, to change of character, bearish. Okay, great. So at this moment in time, we know the M15 has just shifted bearish. Now, we have that information. We're looking to go short. We always trade with the trend. How do we get involved? So let's apply everything we've learned. Well, we know that we're bearish. Great. Now we're going to go from high to low with the fib, right? Just like this. And so now we have 0.5, 618, 786, and of course the full. Now we're going to essentially wait for price to pull back into above the 0.5, somewhere around this area. And then we're going to wait for drop down a time frame and look at the 1 minute structure. And the 1 minute structure, of course, will be bullish. The moment that the 1 minute structure shifts is from bullish to bearish, so like this, the 1 minute is going to look like this when we go into here, right? The moment that this happens on the 1 minute time frame, I'm going to do the exact same thing. We're going to take the fib, and we're going to take the high and the low, and we're trying to do the exact same thing. We're going to put an entry on the 618. We're going to cover the high, and we're going to target the M15 low. So the 0 down here is our target. We just need to wait for this price action shift, right? This is our entry model. It's a break of structure on the 1 minute time frame followed by a change of character, because we know that when this happens, there is a large probability that the M15 is now going to continue moving lower and trading lower. And so we do. And so what we'll wait for is price to come back into at least the 0.5. And so we'll play the next candle. Price comes back into the 0.5. And now we're going to go to the 1 minute time frame. We're going to drop down to the 1 minute time frame. And what we want to just look at is the swings, right? Just the clear swings that you can see. And so if we just look at low, high, doesn't break, high, only liquidation, but still high, low, high, keep playing price, low. So now we're inside of our golden region. Keep playing price. Okay, it creates equal highs. Boom. And once we break this low in here, right, and have our market structure shift, once we see price begin to shift, we know the momentum has died, and now we're ready to take out the M15 low, which is where? Which is this low right here, right? This is the low. So we've come into on here on the 15 minute. We're inside of this premium region. We're looking to go short. We've had the confirmation that market has shifted, right? Because think about it. Sellers are in control. buyers can't take out sellers, and then buyers do take out sellers, and then buyers take out sellers again, and then sellers take out buyers. So sellers have just reclaimed control of the market. But we already know it's not just the 1 minute that's important. We already know that on the 15-minute time frame, this is where fractals come in. On the 15-minute time frame, we're already bearish. So we're already expecting that price goes from bullish to bearish to pullback to lower low, right? We're just looking at it from a different time frame. This is why multiple time frame analysis is super, super important. And so what do? Well, we just go from the high of the price leg on the M1 to the current low, and we'll see. If it keeps going down, we'll stretch it with it, but we just take from the high to the low, and we put our entry on the 618, and we just cover the highs, and we just take out the M15 low, just like that. Because we're just playing what's the highest probability to play out anyway. And so let's play the next candle. Okay, price goes lower. So what do? We just drag this down and we move our entry. Now it's in here, right? And then price pulls in. So we're inside the position. Price shifts lower. And so you can decide this is your full take profit. You can also do a minimum risk reward. When it comes to trade management and trade profits and all of that sort of stuff, those are the decisions you'll have to make for yourself, from YouTube at least. And so let's just go for a 1 to 5, which is the minimum risk reward that I typically take, and all the members of Prosperity Academy typically take. And so that's just literally play out that trade. And that's exactly the strategy. Now, if you want more for completely free, go to the description down below and you'll see a free course, yours for completely free. Enjoy, guys.